So a quick video about seasonality. I'm going to use cocoa as an example. So cocoa, right now. So I just put a short out in cocoa. Of course, that's probably why I'm thinking about it too, but shorted 7 contracts. Average price of 82.63. And if we look at the live quote here, looks like we're at 82.75. So it's bouncing around a bit, but it's moving in the right direction, I think. Um, so the idea being we're sort of short on this rally here. But if we go back and look at this, daily chart here, a little bit longer term, so 2024 is a historical year for cocoa. This is an amazing run. I mean, this is 5, 6 times the price that it's been historically. But it looks like that bull run is over, and that's why commodities trade differently than the stock markets. You've got seasonal trends, seasonal rallies, seasonal deflationary periods based on, you get a shortage, industry, farms, uh, you know, see the higher prices, so they produce more. They devote more land to it, and eventually too much product will take prices down, and then a lot of producers go out of business or quit producing because it's not profitable, and those cycles continue over years. So, cocoa that happens to be seasonally, happens to be cyclically a huge year where there's a shortage. There's probably wars. It's just made in Africa, mostly produced in Africa. But it appears that this whole rally is over. So, we're sort of planning on a long-term decline. But look at what's happened here. We started this downtrend, and then we have this long period of consolidation. So what that says to me, one difference in commodities is that there are buyers and sellers in commodities that are just always buying or always selling. You think of lean hogs or beef. McDonald's is always a buyer of those things because their end product uses those as raw materials. You have a farm, they're a ranch, they're always sellers, and they use futures. The hedge, they're always selling, or they're using futures to hedge. So there's a buyer in here that's just buying away, and this is like the lowest it can get um, based on the trade, meaning everyone has sold their long positions or gotten short, and there's just a big buyer in here that's just. But one of the things with this buyer, whoever this buyer is, or group of buyers, or whatever it is, you know, they're they're seasonally based, meaning, you know, they're they're also, you know, subject to seasonal fluctuations according to supply and demand. So once supply comes to great, you know, they can buy all that they want at this certain price. Eventually, it'll break. So sometimes it takes some time break through these levels. But if I look at what I can do is, so there's some websites that provide seasonal information. So for example, this is average price of cocoa futures seasonally for 37 years. So they take the seasonal fluctuations for 37 years and they average it out. Now, both of these websites I'm going to show you are not really, haven't really done a very good job in making these seasonal charts because if they had, it would start at 100 and it would end at 100, meaning it would take out all long-term trending fluctuations and it would only show seasonality. But they they're enough if I look at a couple of these to sort of figure out. If you look at this, so we have rallies in cocoa in March typically, and then they come down in April, and then the low point of the year comes into May and into June. Then it comes from there uh, into the fall. Then we have a temporary pullback, and then November into December is stronger. So That's that chart. If I pull this chart up, this one's even worse. Look at it, starts at zero and ends up at the high at 15%. So this is not seasonality. It's just because it doesn't have figured into this. Um, the math hasn't been done properly, but still, you're getting the same sort of pattern. You're getting this high in March, April, then this low into May, and then its bottoming is supposed to be in June, July, and then rallying into the fall. So again, not very good, but this is probably a little more useful. Average gains, so over the past 15 years, so percent return. So January is up 1.4%. And it's up 53% of the time. So as you look at February and April, these are the consistently the months where it's up, and you can see February is up 3.9%, April 3.4%. So you can see all this seasonality. This sort of suit fits into these charts, and you can see November is a really strong month, and December is usually positive. So there's your fall rally. But look at May as negative 1.8%, June is negative 0.5%. So I'm coming from April into May. So it's sort of like, okay, we've got a couple of deflationary factors. One is we've had these huge historical rallies to prices 5 times the cost of production, and but that sort of has done. It's run its course. So the supply is coming back online. And then seasonally, we're still in April, so it's April 10th. So we're there's buyers still in there, is the way to put it. But we can see that those buyers are getting all that they want at a certain price, and they're getting filled. And so once the buyer goes away, technically they should be gone by, according to this chart, by the end of April. According to this chart, that buyer should be finished already, should have finished in March. But anyways, really by mid-May. So it's a little bit early, but based on the fact that the market should already be really weak because it's had this big run. Here's another website. It's not a graphical chart, but in that way, but forget about 2024, this all this green here. Again, this has been a historic year if you look at the gains, 2023, but we're looking at these columns, and if you can see, there's just a lot more green in April. This is April when you see this 169 monthly average return, the value 169, I don't know what that means, but you see November is a little bit higher, and August is pretty high, but you see May and June are both in the red here. And in fact, June is the reddest, negative 87, then October, then May. But May, June, 2 months in a row where it's sort of, so you see there's a lot of red. Again, forget the green from 2024, but typically May and June are red. But look, even 2024 in this historical run, and June has this big negative value of negative 1602. So it's only April 10th, so coming into May, June, uh, just expecting seasonal weakness, and we're expecting that that seasonal buyer, who's ever keeping the prices up, who's at here, you know, eventually he's going to run out of gas, and we're expecting that to happen soon. So that's part of why I am a little bit more aggressive in trying to short that. So anyway, that's the idea behind seasonality.